Welcome back, guys. This is part 2 of how to become a passive real estate investor. So let's dive right in. How about due diligence? How do you assess the different investment opportunities that are on your plate? We'll use mobile home parks and parking as an example. When you assess different investment opportunities, there's many different types of factors that you need to consider, such as a sponsor's track record and their experience, as well as the underlying asset quality and the location of that specific property. For example, in our crazy world of mobile home parks and parking facilities, they can offer excellent passive income opportunities if they're managed well and they're located in prime areas. Here are some important points to consider. Market demand. Research the local market conditions for mobile home parks and parking facilities to ensure that there is a strong demand for these types of properties. You should also look into the population and job growth of that specific MSA. You're going to look for areas that have high quality population, high quality job growth. These are very important factors that drive future demand for both mobile home parks, parking facilities, and all the various other types of real estate investments that you're vetting in your personal portfolio. You need to evaluate the infrastructure and amenities in the immediately surrounding area, right? As they can impact the property's desirability and the long-term value. You not only want to have high quality macroeconomics, but also on the microeconomic level, you need to look at dig deep into the individual property itself. In addition to that, you need to dig into the exit strategy. Consider the potential exit strategies for that one investment, such as selling the property, refinancing, or holding for long-term cash flow. You really need to begin with the end in mind. Also, be sure to dig into the sponsor's track record and experience. The success of your passive investment, it relies heavily on the sponsor's experience and track record. Ensure that the sponsor has a history of successful real estate investments and a solid reputation in the industry. Here's some key factors that you should be considering whenever you evaluate a sponsor. 1. Past performance. Review the sponsor's past investment projects and their outcomes. Look for a history of consistently strong returns and successful deals. You're looking for a simple and repeatable business model over long periods of time. Dig into their experience. Assess the sponsor's experience in that specific asset class and the specific market that you're considering. A sponsor with extensive experience in the type of investment you're considering it's more likely to understand all the different nuances and potential challenges associated with that very unique niche. It takes years, decades sometimes, to really master one respective niche. We've been doing mobile home parks for well over a decade now, and we were unwilling to choose any other niches until we really became masters in that asset class. And once we became masters in that asset class, we're comfortable adding an additional vertical. Folks dedicate their entire lives to learning one respective asset class. To think that one individual would be able to master all the various different types of real estate investments out there is foolhardy. You want a pro in their respective lane. Communication and transparency. You need to gauge the sponsor's communication style and their commitment to transparency. A good sponsor should be responsive to investor inquiries and provide regular updates on the investment's performance. Every single month, we provide our investors with a private podcast that gives them the good, the bad, and the ugly every single month on every single deal that they're invested in. It's just important to share that level of transparency throughout the entire holding period. You also need a solid alignment of interest. Ensure that the sponsor's interests align with those of the investors. This can be achieved through the sponsor investing their own capital alongside investors and through performance-based compensation structures. We always invest alongside our limited partners in every deal that we do. In fact, we literally manage hundreds of thousands of dollars of our family as passive investors inside of our various funds as well. So you need to have a solid alignment of interest with your investors in this respective investment. You also need to do your homework on the underlying asset and the quality of that respective deal. Here are some factors to consider when you're evaluating a respective property. You need to dig into the condition of that respective property. On each individual deal that is acquired, everybody does a property condition assessment, which ultimately provides you with insight into just how many CapEx repairs need to be done to bring the property up to stabilization. Something that is already in pristine shape has a higher likelihood of achieving significantly more stable cash flow for you along your investment journey. If it's got an exorbitant amount of value add components or opportunistic asset that needs significantly more CapEx, it'll take a longer time for you to generate more stable passive income in that respective deal. You need to dig into that respective property's location. As we all know, real estate is all about location, location, location. An asset that is on a hard signalized corner on Main and Main is likely to fare better than a significantly more tertiary rural asset in the middle of nowhere over long periods of time. Each individual asset has their benefits and drawbacks, but it is more likely that the individual on a hard main signalized corner will be in high demand regardless of the economic cycle. You need to vet the growth potential of the investment. A lot of this derives from the macroeconomic factors of the MSA. You should also look at the growth potential of that respective property. Assets that are in high quality MSAs that have significantly larger income potential, significantly better job growth prospects, significantly better population growth, have a higher likelihood of just growth potential over time. Regardless of the income generated by that property at acquisition, it's more likely that assets that are in MSAs that have significantly more people moving to that MSA, significantly more jobs attracted to that MSA, those real estate investments will likely fare better over time than if you were in an inverse situation. The last piece of the puzzle is risk mitigation. You need to evaluate the property's risk profile, including factors such as the tenant quality, the vacancy rates, and market competition. A well-diversified property with a strong tenant base can help mitigate risks and provide you with much more stable returns than you would otherwise have. Guys, we got a free gift for you in the description of this video. Look, we're here to help you as much as we possibly can in every step of your investment journey. But it's no secret that our favorite asset classes are mobile home parks and parking facilities. It's what we do every single day. It's what we know. It's what we like, what we trust, what we love doing. And we know it like the back of our hands. If you want to learn more about what, in my humble opinion, is the best asset class in all of real estate, click the link in the description to get our free guide. It's the Passive Investor's Guide to Mobile Home Park Investing. Thanks for joining us today in our quest to help you become a successful passive real estate investor. Remember, by carefully choosing the right investment opportunities and understanding the benefits of passive investing, you can create a steady income stream and secure your financial future, providing real freedom through passive investing. Don't forget to hit the subscribe button and like this video, give us a thumbs up, and leave us a comment with your thoughts or your feelings in the comment section, guys. If you got questions, please let us know. We'll see you in the next video.